There's a critical, a really complex situation unfolding in the real estate world right now, one that's forcing property owners into some incredibly difficult financial choices. Today, we're pulling back the curtain on a detailed case study to see exactly how these high stakes decisions are being made and what insights we can draw for our own understanding of the market.
That's right. We're going to explore the nuanced trade-offs involved in different capital strategies, everything from asking existing investors for more money to bringing in new partners or even selling a property. You'll see how seemingly simple options can have complex consequences and why understanding the why behind these financial maneuvers is just as crucial as the what. It's really about treating debt not just as a liability, but as a strategic lever.
Yeah, exactly. Our mission for you today is to cut through that complexity and arm you with the insights you need to understand how these high stakes decisions are truly made. So let's dive right in. Okay, so imagine a mid-market owner-operator. They've got this 300-unit multifamily property down in Florida. They acquired it back in 2018 for, what was it, $50 million. And they immediately put it through significant upgrades, both inside and out.
A classic value-add strategy.
Yeah.
The plan was pretty straightforward.
Did it?
Improve the property, force appreciation, and boost those rental rates.
Right, but here's where it gets really interesting. As you said, the property's loan, which has a current balance of $34 million, and there's $15 million in outstanding equity. Well, that loan is expiring at the end of this year.
And crucially, there's no prepayment penalty. That's key because it gives them flexibility to act, even with less than 6 months left until maturity.
Okay, so what's created this dilemma for them right as this loan is coming due? Well, they've seen a decline in their net operating income, their NOI.
Yeah, and that's mainly due to higher vacancy, which in turn led to lower rents and increased concessions they had to offer new tenants just to get them in the door.
And on top of that, a recent tax reassessment came in higher than they projected. Plus, insurance costs, pretty typical for a coastal Florida market, have unfortunately risen quite a bit.
Yeah, insurance is a killer down there sometimes. And the debt market isn't making things any easier either. We're seeing lower loan-to-value ratios from lenders. They're less willing to lend as much against the property value. And, of course, higher interest rates across the board.
So the existing lender, they know about these operational challenges, right?
Oh, yeah, they're fully aware. They've offered a 2-year extension, but, this is a big but, it comes with a $5 million paydown requirement and a 200 basis point interest rate increase. That pushes the rate up to 5.25%.
Wow. Okay, so $5 million paydown and a higher rate. Given these pressures and the looming maturity date, what does this all mean for our property owner? They're really at a critical juncture, aren't they?
Absolutely. They've basically identified 4 primary paths forward, each with its own distinct set of advantages and, challenges.
Okay, let's dive into the first one. Executing the lender's extension with a capital call. So that's when the existing limited partners, the LPs, the investors who put money into the deal, are asked to chip in more funds.
Right. The pros here are pretty clear. It provides that 2-year runway for NOI recovery. It essentially buys them time, which they need. Plus, it's usually faster to execute because they're dealing with their existing lender. Less paperwork, maybe?
But the cons seem significant too.
They are. You're looking at that higher interest rate, up 200 basis points, like we said. And a really big risk is that those LPs may not actually fund the $5 million capital call. Maybe they don't have the available funds, or they're just unwilling to invest more into this specific deal right now.
Yeah, that makes sense. And of course, there's no guarantee that the operations will improve as much as they hope within those 2 years, right?
Exactly. It's still a bet on recovery.
Okay, path number 2. Pursuing that same extension with the current lender, but instead of a capital call, they look for outside preferred equity.
This is similar to option 1, but the key difference is it avoids hitting up the LPs for more cash. Preferred equity, for those listening, it's a kind of a hybrid investment. It sits between traditional debt and common equity in the capital stack, often used to, bridge these kinds of funding gaps.
But there's a potential downside with preferred equity too.
There can be. It might be dilutive, meaning it reduces the ownership stake of the current investors, or it could be subordinated in a way that means the press equity gets paid back before the original LPs in certain situations. And that, understandably, could upset the original investor base.
Okay. Option 3 then. Refinancing with a completely new lender. What are the potential upsides there?
Well, you might get a lower or maybe even no buy-down requirement. They might not need to pay down that $5 million in principal. Plus, a new loan typically offers a longer term, usually 5 to 10 years. That gives them a lot more breathing room for market recovery and those operational improvements.
But it's not all smooth sailing.
No, Definitely not. It's a slower execution. You've got the whole underwriting process with a new lender, which takes time. The new loan, even if it avoids the $5 million paydown, still might require some fresh capital to close the deal. There are always costs involved,
Yeah.
and there's always that inherent risk, especially now, that market interest rates could continue to rise while they're going through the application process.
Right. Timing risk. And finally, option number 4, marketing the property for sale. Just get out.
Exactly. The positive side. It offers a possible full return of equity for the owners and the investors, allows them to exit the deal, maybe get out whole or at least cut their losses. It also completely eliminates the operational risk of, further market decline. And obviously, no capital call needed.
But the drawback sounds pretty major too.
It is. Selling in this kind of market would likely mean below target returns. And that could really strain future relationships between the general partners, the GPs, the firm managing it all, and their LPs. You don't want a reputation for losing money, and of course they lose out on any future potential upside if the market does recover and the property value increases down the line.
So 4 distinct options, each with pretty significant pros and cons. How do you even begin to analyze this?
Well, when we approach a scenario like this, the process involves several layers of pretty deep analysis. First, we sit down with the borrower. We need to truly understand the specific drivers behind that NOI decline. Is it just vacancy, or are taxes, insurance, maybe management issues playing a bigger role than they think? We also really dig into their short-term and long-term operational recovery plans. What exactly are they going to do? And what's their projected timeline for getting that NOI back up and stabilized?
That's a critical first step. But how do you go beyond just the surface reasons like higher vacancy? How do you really pinpoint the specific market shifts or internal factors driving it? What tools or data help you dig into that root cause?
Right, it's about getting granular. For instance, if vacancy is high, is it because the whole submarket is oversupplied with new units? Or are their units simply not competitive anymore on price or features? We look at detailed submarket reports, lease-up data from competitors, sometimes even anonymous resident surveys to get the real picture. Beyond that, we scrutinize all the partnership agreements. We need to understand the exact impact of these potential recovery options on both the sponsor, the GP, and the LPs, especially concerning that potential $5 million capital requirement. What does the agreement say about capital calls?
That makes sense, checking the fine print.
Exactly. Then we dive deep into the debt market. We need to identify the right type of lender for a potential refinance. This means looking at the agencies Fannie Mae, Freddie Mac, great for stable long-term financing on multifamily, maybe HUD, another federal option. Then there's CMBS, it's commercial mortgage-backed securities. Life companies, the big insurers. Debt funds, which can be more flexible but often pricier. And of course, traditional balance sheet lenders, like your regional banks. We gather data on typical terms, interest rate spreads, loan-to-value ratios, how quickly they can execute from all these different sources.
Okay, that covers the debt side. But what about the equity side, especially thinking about that $5 million paydown requirement from the current lender? That's a lot of cash to find.
Yeah, it is. So what's fascinating here is that we also explore equity alternatives in parallel. We talk to preferred equity partners, potential joint venture partners, various private and public equity funds. We then meticulously compare all the term sheets we might receive. Those are the non-binding offers from both lenders and potential equity investors. We analyze the cost of capital, what's the interest rate, or the required return. We look at the different structures proposed, distribution hurdles, those are the triggers for when profits get paid out, hold periods, exit fees, all the details matter.
Wow, that's a lot of comparison.
It is. And the final step is comprehensive financial modeling. We project the impact of each potential capital structure on investor returns, both for the LPs and the sponsor's goals. This includes looking at straight debt scenarios, maybe debt combined with equity, scenarios for both the capital call and bringing in a new equity partner for the extension. Sometimes we even model earnout possibilities, where future funding might be tied to hitting certain NOI targets.
This sounds like a really intensive process for just one property. But this isn't just a one-time fix, is it? We often hear about firms taking a more proactive approach across their entire portfolio. How does this kind of strategic thinking fit into a broader operational model?
That's a great point. If you connect this to the bigger picture, what you'll find is that the top commercial real estate firms, they integrate their entire portfolio into a cohesive system. This allows for regular, say, quarterly reviews to identify loan maturities coming up on the horizon, or maybe opportunities based on current market trends. They track everything, Total properties, current valuations, the average weighted maturity of all their loans, total equity, total debt, the average weighted interest rate across the whole portfolio. It's all data-driven.
So they have a dashboard, basically.
Pretty much. They cross-reference upcoming maturities with forward interest rate curves, which can change daily, and use internal scorecards or heat maps. These tools help them quickly spot potential issues or opportunities based on their equity position in a property, current market conditions, and maybe favorable interest rates for a refi or sale. This whole systematic approach helps them stay ahead of the curve and truly treat debt as a strategic lever, not just a problem to be solved.
Okay, so back to our specific case study. After all that analysis and modeling, what was the recommended solution?
Right. So let's look at the results of the modeling for this specific property. A key factor here was the borrower themselves. They are a long-term generational holder. That means they typically don't sell assets. So an outright sale, option 4, was immediately off the table for them. It just wasn't in their DNA.
Okay, so selling was out. What about refinancing?
A full refinance also proved really difficult. Even after exploring all those different lender types we talked about, we just couldn't find a new lender willing to provide enough proceeds to fully pay off the existing $34 million loan, given the current NOI and market conditions.
So that immediately narrowed it down, didn't it? It came down to the two extension options, the capital call or bringing in preferred equity. What was the deciding factor there?
This raises that really important question. What did the LPs, the existing investors, actually prefer? We found that many LPs simply didn't have the extra capital readily available right then, maybe due to other real estate investments they held that were also facing challenges in the current environment. And frankly, they overwhelmingly preferred not to be hit with a capital call.
Even if the alternative meant some dilution.
Exactly. Even if it meant a little dilution of their current stake, they favored the idea of bringing in a preferred equity piece to cover that $5 million paydown. So our model ultimately showed that the preferred equity solution was the best fit for this specific situation. It gave the owner the necessary 2-year runway to hopefully bring up their NOI. The anticipation being that the value-add work would finally be finished, the property would be more competitive, and those vacancies would diminish.
And what did the projected returns look like with that solution?
The model projected a deal multiple of about 1.8x, meaning investors were projected to get back roughly 1.8 times their total investment over the life of the deal, and an internal rate of return, or IRR, of almost 8.4%. Look, it certainly wasn't the home run they initially hoped for back in 2018, but for this specific transaction in this really challenging market environment, it was actually a pretty sound strategic solution. It kept them in the game.
That really highlights how context-dependent these decisions are.
Absolutely. And what's fascinating, stepping back again, is how today's top commercial real estate firms really do treat debt differently. It's not just a fixed liability you chip away at. It's seen as a strategic lever for growth and creating long-term value.
That's such a powerful idea. So it sounds like this isn't just about fixing problems when they pop up, but truly being proactive, always thinking ahead.
Absolutely. You nailed it. Effective debt optimization, as we see it, really hinges on 3 pillars. First, organize your asset positions. You need a clear, real-time understanding of everything you own, all the debt terms, maturities, everything.
Okay, organize. Get your house in order.
Second, triage potential issues. That means constantly identifying what maturities are coming up soon, which assets might be underperforming, and importantly, what opportunities might be emerging because of market shifts.
Triage. Spotting the priorities.
And third, optimize your capital structure. Actively exploring how to best finance your portfolio. Should you refinance this one? Sell that one? Bring in equity here to maximize returns and minimize risk. And crucially, this isn't a one-time activity you do when a loan is due. It's a process executed on a recurring basis, constantly.
Like a continuous cycle.
Exactly. It means constantly evaluating where you stand on equity and debt across the portfolio and understanding when the time is ripe to explore solutions and leverage your equity most effectively.
That makes a lot of sense. A crucial part of this continuous process must be understanding the current market appetite for capital, right? You need to know who's lending and investing and on what terms. So what are the various debt providers looking for right now? What's the mood out there?
Yeah, this is where the nuances really come in, and it changes fast. For multifamily properties, like our case study, the agencies Fannie and Freddie are still quite active. They typically offer interest rates somewhere between, say, 5.25% and 6% right now. And critically, they often allow a lower debt service coverage ratio, or DSCR, sometimes as low as 1.15x to 1.2x. That lower DSCR is key because it basically means they're comfortable lending a bit more relative to the property's net income, which can mean more leverage for the borrower.
And they offer long amortization periods, too.
Yeah, typically 30-year amortization, which helps with cash flow. HUD is also an option for very long-term government-backed financing, though it can be a slower process. Then you have retail banks. They seem motivated to do business, maybe offering rates from 5.75% to 6.5%, sometimes fixed, sometimes floating, often looking for around 80% LTV and maybe a 1.2 max DSCR.
What about the non-bank lenders, the debt funds?
Debt funds, both private and public ones, they're generally pricing higher, maybe between 7% and 9%, usually with floating rates, but they often offer flexibility, like interest-only periods for a couple of years, which can help near-term cash flow even if the rate is higher. And CMBS, that market's currently pricing loans around 6.5% to 7.25%, maybe 60-75% leverage, typically fixed rate. But CMBS usually comes with a 10-year term, so it might not be the best fit for a short, say, 2-year extension plan where the goal is just quick NOI improvement.
Okay, that's a helpful snapshot of the debt side. What's the appetite for different types of asset classes right now? Are investors being more cautious, selective?
Very much so. Equity providers are deploying capital very cautiously. They're being highly selective in terms of the markets they'll invest in, the sponsors or GPs they'll back, and the specific asset classes. It really feels like a flight to quality right now.
So what kind of deals are getting done?
Institutional providers, the big players, they seem to be favoring what they call core plus and value add deals. Core plus means stable assets with just a little bit of upside potential. Value add is like our case study properties needing improvements to boost income. But, and this is important, they're mostly sticking to primary markets, the big gateway cities, and only very select secondary markets. They're not really venturing into tertiary markets much right now.
And are they demanding higher returns for taking that risk?
Yes, definitely. We're seeing preferred equity returns widening out, typically looking for somewhere between 11% and maybe 15% IRR these days. And that preferred equity is increasingly being used exactly like in our case study to plug gaps in the capital stack, basically filling the holes in financing created by falling asset values where traditional debt or common equity might not fully cover the need anymore.
That's incredibly insightful. It sounds like there's a real paradox, though you have this cautious capital deployment, but at the same time, widening preferred equity returns, meaning higher costs for borrowers. How does that tension play out in negotiations? What does it mean for owners who are already in a tough spot?
Yeah, it creates a really challenging environment. Owners need the capital, often desperately, but the investors providing it are demanding a higher premium for the perceived risk they're taking on in this market. What it means for owners is they have to be meticulously prepared. They need to present extremely clear operational recovery plans. They have to demonstrate why their specific asset is resilient, even if it's currently underperforming on paper. There's just less wiggle room in negotiations right now.
How does this vary by property type? You mentioned multifamily.
Right. For multifamily, equity players are, let's say, cautiously positive. The demand drivers are generally strong. People always need a place to live. But those rising insurance and tax costs are a real national concern, dampening enthusiasm a bit. Industrial, like warehouses and logistics centers, still very positive. High investor appetite, strong market fundamentals, lots of demand driven by e-commerce. Office, however, is broadly negative. It's tough out there. Preferred equity is rarely being used for office unless there's an exceptionally strong sponsor behind the deal or a really compelling, unique repositioning plan for the building.
And retail. Hospitality.
Retail gets mixed reviews. Grocery-anchored shopping centers, things seen as necessities, still attract interest, but large regional malls, generally avoided by most institutional equity right now. Hospitality is guarded. There's some interest, but mostly in well-located properties in large cities, maybe leaning towards luxury or specific niches. Not a broad appetite. Student housing is actually a growing area. We're seeing specialized players increasing their exposure there, seeing it as somewhat recession-resistant.
Wow. What an incredible deep dive into this complex, dynamic world of commercial real estate finance. From that single properties dilemma to the broader market trends and appetites, it's just so clear that strategic, proactive thinking is absolutely paramount.
Indeed. And I think the underlying lesson here, it isn't just for the experts working in commercial real estate. For you, the listener. Whether you're navigating your own personal finances, maybe considering a small business investment, or even just observing the broader economic trends,
Yeah.
recognizing debt not just as a liability you have to pay off, but as a potential strategic lever that can fundamentally change your perspective on building value.
That's a fantastic takeaway. So as you reflect on this discussion, maybe consider how might thinking about your own financial landscape, personal or business, with that organized, triage, optimized mindset shift your approach to achieving long-term value and growth. Keep exploring those ideas, and we'll see you on the next deep dive.